Good afternoon, everyone. I am Zyla A. Masaras, and our topic is about insurance and investment, and I will be discuss about types of insurance and investment. So now, let's talk about insurance. There are many types of insurance, but some common types are described here. First, health insurance. Health insurance help you pay for doctor fees and sometimes prescription drugs. Once you buy health insurance coverage, you and your health insurer each agree to pay a part of your medical expenses, usually a certain dollar amount or percentage of the expenses. And there are two types of health insurance. First is private insurance and second is public or government insurance. Private insurance refers to any health insurance coverage that is offered by a private entity instead of a state or federal government. And the public or government insurance includes plans funded by governments at the federal, state, or local level. And the other types of insurance, some people may also define an insurer by the way it administers its plans and connects with providers. These are health maintenance organizations or HMO, exclusive provider organizations or EPO, and point of service plans or POS, and last is preferred provider organizations or PPO. Health maintenance organizations or HMO give you a local network of participating doctor, hospitals, and other healthcare professionals and facilities that you are required to choose from. These types of health insurance plans also require you to choose a primary care provider or PCP from the network. Your PCP is your home base for medical care. And the next is exclusive provider organizations or EPO. An EPO offers you a network of participating providers to choose from. Most EPO plans do not include coverage for out-of-network care except in the case of an emergency. This means that if you visit a provider or facility outside the plan's local network, you will likely have to pay the full cost of services yourself. And the next is point of service plans or POS. Point of service plans combine features of HMO and PPO plans. The provider network is typically smaller than PPO plan, and the cost per in-network care are typically lower like an HMO. POS plans also require you to choose a primary care provider or PCP from within the plan's network of doctors and other primary care professionals. Your PCP is your home base for care and advice. And last is about preferred provider organizations or PPO. PPO typically offer you a large network of participation providers, so you have a lot of doctors, hospitals, and other healthcare professionals and facilities to choose to see from. Next is about the second types of insurance. It is life insurance. Life insurance pays a person you select a set amount of money if or when you die. The money from your life insurance policy can help your family pay bills and covers living expenses. There are different types of life insurance. These are term life insurance. These policies last for a specific number of years and are suitable for most people if you don't die within the time frame specified in your policy. It expired with no payout. And next is permanent life insurance. These policies last your entire life and usually include a cash value component which you can withdraw or borrow against while you're still alive. Next is whole life insurance. Typically lasts until your death as long as you pay the premiums. It's the closest thing to set it and forget it. Life insurance. In general, your premiums stay the same. You get a guaranteed rate of return on the policy's cash value and the death benefit amount doesn't change. Next is universal life insurance. The death benefit is guaranteed and your premiums won't change. There's typically little to no cash value within the policy and insurers demand on-time payments. And the variable life insurance is tied to investment accounts such as bonds and mutual funds. Variable life insurance premiums are typically fixed and the death benefit is guaranteed regardless of how the market pairs. Next is group life insurance. It's typically offered by employers as part of the company's workplace benefits. Next is mortgage life insurance. Cover the current balance of your mortgage and pays out to the lender, not your family if you die. And the credit life insurance pays the balance of a specific loan like a home equity loan. Your bank might offer to sell you a credit life insurance policy when you take out a loan. If you die, it pays off the lender, not your family. And next is about accidental death and dismemberment insurance. Covers you if you die in an accident such as a car crash. AD&D insurance also pays out for the loss of limbs as well as the loss of your sight or hearing. And the last is about joint life insurance. Insures two lives, usually those of spouses under one policy. First to die is about pays out after the first policyholder die. The policy would then expire. It doesn't continue to cover the second person. These policies are extremely rare as the demand for them is low. And the second to die is about pays out after both policyholders die. These policies can be used to cover estate taxes or the care of a dependent after both policyholders die. And next is about the third types of insurance. It is disability insurance. Disability insurance protects individuals and their families from financial hardship when illness or injury prevents them from earning a living. Many employers offer some form of disability coverage to employees, or you can buy an individual disability insurance policy. There are two main types of disability insurance. First is short-term disability insurance. It is only pays benefits for up to a year. And the second is long-term disability insurance. It can pay until you reach retirement age. And the fourth types of insurance is auto or car insurance. Auto insurance protect you from paying the full cost for vehicle repairs and medical expenses due to a collision. In most states, the law requires you to have auto insurance when operating a motor vehicle. And the last types is homeowners or renters insurance. It protects your home and personal property against damage or loss and insures you in case get hurt while on your property. If you have a mortgage on your property, most lenders require you to have homeowners insurance as a condition of the loan. Now, let's talk about types of investment. The question what is investment is mostly followed by understanding your investment objectives and identifying where to invest. Keeping aside investments in real estate and assets like jewelry and all, when it comes different instruments, another aspect of understanding what is investment meaning is to know about different types of investment. The following are the different types of investment. First, stocks. Stocks, this includes shares of ownership of any company and helps you earn dividends in return. There are four types of stocks. First, growth stocks. Second, dividend or yield stocks. Third, new issues. And fourth is defensive stock. Growth stock, these are the shares you buy for capital growth rather than dividends. Growth stocks are essentially shares in those companies that are generating positive cash flows and whose earnings are expected to grow at an above average rate relative to the market. And the second is dividend or yield stocks. Yield stocks ideally are those that perform well in bull markets while providing partial downside protection for investors in bear markets. They are the stocks of choice for the income-seeking investors. The stock yield is calculated by dividing the yearly dividend paid by the company to the company's share price. And the third is about new issues, also known as initial public offerings or IPO. These are why the share market was created in the first place. These events mark the first time that companies make their shares available to the public. And the fourth is defensive stocks. These are the shares that don't go down so much when times are tough because they sell consumer staples. Typically, these types of stocks provide a constant dividend and report stable earnings regardless of the state of the share market as the whole. And the second types of investment is bonds. Wondering what is investment meaning in terms of bonds? It means lending your money to an institutions or government for which you receive and also the face value upon maturity. There are two common types of bonds, corporate bonds and government bonds. Incorporate bonds are a way for companies to raise capital without having to issue shares or seek other forms of financing. Companies sell them directly to investors at varying maturities, but this offers some flexibility around when they can be redeemed or when the issuer can pay back the loan. They tend to be longer-term investment. Corporate bonds also offer a high yield than government bonds. That's because even profitable companies have a higher default risk that a government and investors expect to be compensated for the risk they take when they lend them money by buying their bonds. There are two main categories of corporate bonds. First is investment-grade corporate bond. An investment-grade bond is one from a company that has stable earning and solid financially, which means investors can expect to get their money back. And the second is high-yield or junk bond. A high-yield or junk bond belongs to a company that has higher risk of defaulting on its loan payments because of high levels of debt or variable revenues and earnings. This company's credit risk is considered speculative grade or below investment grade. To make up for the additional risk, these bonds usually have higher returns than other bond portfolios. And the second common type of bonds is government bonds. Government bonds are considered the safest type to invest in because they are issued by large, stable, national entities. They're used to help fund government spending and tend to pay periodic interest as well as the bond's face value on the maturity date. They typically pay less interest than corporate bonds because of their lower risk. There are different types of government bonds. First is federal. These are bonds issued by countries' federal government which have the power to print money to pay off their debts, so investors consider this almost risk-free. And the second is provincial. Our state government can also issue debt. These bonds are also considered to be safe because provincial governments can levy income and sales taxes to support their debt payments. But since provincial governments can't print money, these are step below the bonds issued by federal governments on the risk scale. And next is municipal. Cities, towns, countries, and regional municipalities issue government bonds supported by their property taxes. School boards also issued by bonds supported by their ability to levy a portion of property taxes for education. These typically make a small part of the market and have pretty low yields, but most are tax-free. So, you don't have to pay federal tax on income you make from the bonds returns. And next is agency. Many government-related institutions issue bonds, some supported by the revenues of the specific institutions and some guaranteed by a government sponsors. And the last is treasury bonds, or T-bonds, are issued by federal governments and have maturities of more than 10 years. The bondholder will get paid interest while holding the bonds and an amount at maturity as well. And the third types of investment is about mutual funds. Mutual funds, in this, funds are collected from different investors and put in a company's bonds or shares, which are managed by fund managers. On understanding what is investment meaning and your investment objectives, you may choose equity funds depending. And the fourth types is about unit-linked insurance plans. These are a type of investment that provides both investments and life insurance benefits. A portion of the money investment into unit-linked insurance plans is located for investment, meaning in this plan, a part of your premium is invested in different funds and helps you earn market-linked returns. And the last is public provident fund. It is understanding investment meaning of PPF is simple. It is government's offered savings scheme that invests your funds for a specific period and help you earn return on the same. And these are my references. And that's all. Thank you for listening and I hope you learned something